About 60% of the entire working force in the US have monies whether actively or passively invested in the stock market. About 51% also of households without a college education have their monies also invested in the stock market. And about 8 out of 10 of multimillionaires and billionaires equally have their monies invested in the stock market. Now the question is, why are they all investing in the stock market? And would you want to join them? That doesn't sound like a question, it's a rhetoric. Because if you truly want to build wealth, there's one thing that you need to know. Investing money in the stock market is nothing but a necessity. And so what you need to know is that there are lessons that actually govern you putting money in the stock market. And so in today's video, I'm sharing the 9 lessons that you need to know, of course, with reference from what Warren Buffett has actually been sharing over the years when it comes to actively investing money in the US stock market. And so if you're new here, my name is Nana. I hold a master's degree in business finance, and on this channel we discuss everything personal finance and personal development. And so without further ado, we come to the first lesson, and that is investing is not a get rich quick scheme. So what you need to know is that if you truly want to build wealth by investing in the stock market or picking stocks, there's one thing that you need to highlight, and that is the fact that it takes time to actually build wealth. Now Warren Buffett over the years has invested for a little over 8 decades, that is 80 years of consistently having to contribute by way of buying stocks marginally in the stock market. And today he has in excess of $100 billion. And what you need to know is that it actually takes time to build wealth on the stock market. Don't follow all these gurus online trying to sell you courses as to how to build wealth within the shortest possible time, or invest in so and so and you get the marginal returns or huge returns within the shortest possible time. As opposed to this, try as much as possible and focus on your investment goals, and then build wealth marginally and consistently over time. And then with time, you'll be able to benefit from the compound interest effect on the stock market and then build wealth overall. And so with this understanding, we move to the second point, and that is let your goals or your investment goals be your compass. So one of the key things that you need to know is that before you go on to invest, you need to establish a goal. The why you're investing factor is extremely important. So sit down and then ask yourself the simple question: why do I really want to invest in the stock market? Or what goal or what financial goal am I working towards? Is it to buy a house, or to save up my minimum deposit to actually get a mortgage, to pay for my kids' college tuition and all of those things? When you establish the goal, it gives you a clear roadmap and the things that you need to do, more importantly, and how you'd actually consistently have to invest in the stock market in order to reach whatever goal that you sit down to write for yourself. This brings us to the third investing lesson, and that is don't put all your eggs in one basket. And the easiest way that you can actually go about this is to diversify your investment. So in the market, there is something that is popularly known as an index. And an index is a group of companies that you can actually invest into. So what Warren Buffett simply advises is that you buy into a market index. So the S&P 500, for instance, is a market index, and that is the top 500 or the biggest and the most performing companies in the US, the top 500 companies in the US. So if you were to invest $100 into the S&P 500, what it does is that it divides your $100 amongst all the other top companies that are performing in the US. That is the Microsoft, the Apples, the Teslas, and all the big companies that you can think of. So in the case where Tesla is not performing, Microsoft might be performing, and it will also drag your investment up a little bit. Or in a case where Microsoft is not performing, Tesla's sales and its overall performance will be going up. So it balances out the losses against the gains in the investment market. And that is one of the key things that you need to know before going out there to invest in the stock market. This brings us to the fourth investment lesson from Warren Buffett, and that is to do your homework before actually going out there to invest. So what you can simply do is that you can do dummy investing. That is, you're not putting money actively into any stocks, probably for a couple of months, just to see how you would have otherwise performed if you had put real money in the stock market. And what you need to know is that you need to read books, try as much as possible to follow several other podcasts out there. You can try in one way or the other to follow several other influencers that you can trust. Search for several other Warren Buffett interviews with CNBC, and it would actually give you some insight as to what you really want to invest in and what you really want to do in the stock market. Because education is one of the key ways that you can actually build wealth. And when you don't know what you're doing, you're likely going to fumble and make all the bad mistakes, and then most likely lose your hard-earned money. So try as much as possible to have a fair idea of what you're doing before going out there to start investing. This brings us to the fifth investment lesson from Warren Buffett, and that is to use logic and not emotions. So one of the key things that he highlights is the fact that you've got to be greedy when everyone else is fearful, and you've got to be fearful when everyone else is greedy. And what that simply means is that anytime that people are actively, and there is a hype about the stock performing and people are investing so much in the stock market, that is the time that you have to step back. And anytime that people are scared, that is when prices of several other stock out there have tumbled, and that is an opportunity for you to rather invest money. So when people are actually taking their money out of the stock market, that is when you should be investing. And when people are pumping hundreds of millions and billions into the stock market, that is when you should be selling. So that is one of the easiest ways for you to actually see some success in the stock market altogether. This brings us to the sixth timeless lesson from Warren Buffett, and that is you can't time the market. So according to Buffett, one of the key things that you need to do is that you need to try as much as possible to be in the market and not try and then time when to actually step in the market. There's a popular saying that time in the market beats time in the market, and that is because when you're actually actively contributing into the stock market, it actually balances out your contributions, and so does it also balance your gains over time, because you don't know when exactly. Even top investors like Warren Buffett actively sit on telly and then tell people that if I'm able to tell you what the stock market is going to do in the next 24 hours, I'll be lying to you. So try as much as possible and then contribute irrespective of whatever is happening in the stock market. That consistency is what would eventually steer you towards the attainment of your success in the stock market. This brings us to the seventh lesson, and that is to watch out for fees. So for most starters, they don't really consider how much it would cost them in commissions and several other management fees if they have to invest in ETFs or several other portfolios out there. So what you need to know is that you want to choose the most cost-effective and the most efficient way of investing or starting to invest in the stock market, and that is to choose a platform that can help you or prefers the slightest or the lowest form of cost when it comes to managing your money and investing or picking stocks on your behalf. Or if you're actively doing it, try as much as possible to download the apps with the lowest fees, and that would help you to contribute towards the gains that you make in the stock market, as opposed to having to pay several hefty sums in commissions on the investments and the progress that you make in the stock market. This brings us to the eighth investment lesson, and that is trading is not the same as investing. So for day traders, what they do is that they have hefty sums of money, and so they invest actively and then they sell when those stock prices actually go up. So they are actively always more or less on the stock market looking for ways and means to make money. So when they buy low, they sell high. That is what they do. But for investing, what you really want to do, you don't want to be actively investing in the stock market unless of course you have hefty sums of money to actually invest. What you want to do instead is to consistently actually contribute to the stock market by way of dollar cost averaging. And dollar cost averaging simply means that you set an automated payment. For instance, in my case, every Friday, money goes out of my account into my investment portfolio, and that ensures that I have some level of consistency and I'm able to evenly spread out my contributions and also gain from the stock market, irrespective of whatever is happening on the stock market. This brings us to the last investing lesson according to Warren Buffett, and that is to start investing early and do it consistently for a very long time. So one of the easiest ways to actually become a multi-millionaire is to invest for 30 years, but to invest $500 every single month in the S&P 500. And that is you'll be attracting 7% interest per annum. But what you need to know is that if you're able to do this for 30 years, then you're likely going to have £1 million or $1 million and in excess of that when that 30-year period is due. So currently, I'm 28. If I really want to take this advice and then actively work on that, by the time that I'm done, I'll be 58. But if I'm to delay further, then it means that I'll be pushed further into my early 60s or mid 60s or even late 60s. And that actually ensures that I wouldn't be able to actively take advantage of compound interest effect in the stock market. So the earlier you start, the better. And try not to get all money saved up before you start investing. You can start investing periodically and consistently per week, probably with as low as $10 or £10. And then over time, when the momentum actually gathers, or you actually have some level of confidence in your investment portfolios, then you add more or you invest more in the stock market. And so if you found value with this video, kindly smash the like button. It really helps with the algorithm. And then consider subscribing, even as we are all on the journey towards the pursuit and the attainment of our financial goals. Thank you for spending time with us, and see you in the next video.